Welcome back to AI Mindblowing, where we discuss the amazing ways that AI is modifying across a variety of sectors. We're going to go into the accounting industry today and talk about how artificial intelligence is changing the work of chartered accountants. We will see how AI will help chartered accountant in finance. For chartered accountants, large quantities of financial data are nothing new. With AI's help, these experts can now concentrate on more crucial tasks and optimize their workflows. Expert opinion: for us, AI has changed the game. It has automated routine tasks like data entry and reconciliation, freeing us our time to analyze complex financial issues and give our clients insightful information. The ability of artificial intelligence to identify irregularities and possible fraud in financial data is one of the most important advantages for accounting. Artificial intelligence is a tool that can be used to maintain the accuracy of financial data by identifying trends and abnormalities. Moreover, AI can generate comprehensive reports and forecasts by processing and interpreting financial data at a speed and scale that surpasses human capabilities. This not only enhances the accuracy of financial analysis but also enables accountants to make more informed decisions. In addition, artificial intelligence can process and interpret financial data more quickly and effectively than humans, producing detailed reports and forecasts. This improves financial analysis accuracy and empowers accountants to make more knowledgeable decisions. In the accounting and financial sectors, chartered accountants, or CAs, are essential. They are in charge of making sure businesses maintain their financial integrity, offering audit and assurance services, and offering insightful information to help with company decision-making. However, the expectations on CAs are rising in the dynamic and demanding world of today, and conventional approaches to accounting and finance are becoming antiquated. In this situation, artificial intelligence, AI, and machine learning, ML, are crucial in assisting CAs in overcoming these obstacles. Machine learning implications for auditors. Auditors have the option to run an entity's whole ledger through automated analysis in place of sampling data. By the way, this is a feature that is already present in tools like IDEA and ACL. It is not artificial intelligence, AI, or machine learning. These human-designed tools are capable of carrying out a wide range of studies and can subsequently provide lists of exceptions for the auditor to review. When the auditor validates or invalidates an exception, machine learning enters the picture. The machine gains the ability to look at the auditor's conclusions and attempt to find more information about the positives or negatives to apply to other exceptions it finds. It gains improved ability to recognize exceptions in this way. In this application, the risk of data bias arises from the possibility that machine learning could begin to flag other items that ought to be exceptions if an auditor incorrectly marks items that need to be verified as exceptions. Thus, it is necessary to provide a review procedure to make sure that exceptions that have been cleared are actually not exceptions. It also holds true that exceptions that have been verified shouldn't qualify as exceptions. In a more sophisticated use case, an AI tool may be given a set of transactions, and machine learning could be used to recognize patterns in the transactions and determine what constitutes a normal transaction. It would then classify as exceptions those instances that deviate from the norm using this methodology. Because its representation of a typical transaction is dependent on the given data set, this machine learning application is therefore susceptible to data bias. Since criminal activities are quite common in the data set that the AI learns from, they may be perceived as legitimate transactions if the data set that was utilized also had a high incidence of fraudulent transactions. Even as machine learning begins to enhance audit processes, human auditors will undoubtedly be needed in the future. Both internal and external auditors will now have to establish procedures, interpret data, and keep an eye on how well the interpretations are being made instead of just carrying out the procedures. Machine learning implications for management accountants. Machine learning can be used to assist with transaction classification inside the controllership role. To help predict the classification of new transactions as they are recorded, inductive reasoning could be used on the past transaction source data. In general, this is acceptable because many vendors' items naturally fall into a similar category. However, depending on how their product is used, some sellers could fall into multiple natural groupings. Consider an email newsletter tool that is used to send customers marketing and promotional emails and is categorized as an investment in advertising. It might be categorized as an IT expense or under employee relations instead, though, if it were utilized to create employee newsletters. Depending on the significance of the possible inaccuracy, human validation of the classification for vendors with this risk can be required. Machine learning can be used in financial planning and analysis, FP&A, to evaluate data and develop or improve forecasting data models. The caliber of the data collection being used and the possibility of innate biases could also have an effect on how well machine learning predicts the future. Because of the implications of the datasets that are utilized in their models, FP&A accountants need to be cautious.